Last month, I logged into my credit card account to pay my bill. A pop-up appeared before I could do anything else. Update your annual income to help us serve you better. There was a friendly little form with my old income pre-filled and a box inviting me to enter my current number. Serve me better. That's what they said. I closed the pop-up without updating anything because I know exactly why they're asking, and it has absolutely nothing to do with serving me better. Here's what most people don't realize. When you tell a bank your income, you're handing them ammunition. You're giving them data they will use to make decisions about your financial life, decisions that benefit them, not you. Every single time you update that income field, algorithms start running. Calculations begin. Your profile gets adjusted in ways you'll never see, but will absolutely feel. Banks have convinced us that sharing income information is routine, expected, maybe even required. They slip income questions into applications like they're asking your phone number. They send those friendly update requests disguised as customer service. They make the whole process feel so normal that most people never stop to ask a basic question. Why do they actually want this number? And what happens when they get it? The answers might fundamentally change how you interact with financial institutions from this point forward. Let me start with something that will probably irritate you. Banks are not required to ask for your income in most situations. There's no law mandating that credit card companies know your salary. There's no regulation requiring your bank to have updated income information on file. They ask because they want to know. They ask because knowing helps them make more money from you. This distinction matters enormously. When something is legally required, you have to provide it. When something is requested, you have choices. Banks deliberately blur this line because informed customers make decisions that hurt bank profits. Think about the last time you applied for a credit card. The application probably asked for your annual income. You probably entered it without thinking. Why wouldn't you? It seems like standard information. Everyone asks for it. But here's what happened behind the scenes the moment you submitted that number. The bank's algorithm instantly categorized you. Your income became a data point in a profile that determines how they'll treat you. Not just whether you get approved, but what interest rate you'll pay, what credit limit you'll receive, what offers you'll see, and how aggressively they'll market additional products to you. Let me break down each of these because the mechanics are fascinating and slightly disturbing. Credit limits are the most obvious use of income data. Banks use your stated income to determine how much credit to extend. Higher income generally means higher limits. This seems reasonable on the surface. Someone earning $150,000 can theoretically handle more debt than someone earning $50,000. But here's the twist. Higher credit limits aren't always in your interest. They enable more spending. They create more opportunity for debt accumulation, and they increase the total interest you might pay over time. Banks know that people with higher limits tend to carry higher balances. A $30,000 credit limit doesn't just mean you can spend more, it means you probably will spend more. The bank isn't giving you a high limit as a reward for your success. They're giving you more rope because customers with more rope tend to hang themselves with interest payments. Interest rate determination is where income data gets weaponized in ways most people never see. You might assume that higher income leads to lower interest rates. After all, higher earners are lower risk borrowers, right? The reality is more complicated. Banks use income data in combination with other factors to determine not just your risk level, but your price sensitivity. Someone earning $200,000 might be less likely to shop around for a better rate. Someone with substantial income might not notice or care about a few percentage points difference. The algorithm knows this. It adjusts accordingly. Studies have shown that affluent customers sometimes receive worse terms than they should because banks correctly predict they won't bother negotiating or switching providers. Your high income becomes a signal that you can be charged more without losing your business. This practice has a name in banking circles. It's called ability to pay pricing. The more you can afford, the more they charge. Not because you're higher risk, but because they can get away with it. Marketing and upselling represent the most persistent way banks use income data against you. The moment you reveal your income, you get categorized for targeted offers. High earners receive aggressive pitches for premium cards with high annual fees. They see constant offers for personal loans, investment products, and insurance packages. Every login becomes an obstacle course of upsells, carefully calibrated to your income bracket. Banks know that someone earning $180,000 is more likely to say yes to a $550 annual fee card than someone earning $60,000. They also know that high earners often have more financial complexity, which creates opportunities to sell additional services. Your income data isn't just sitting in a database. It's actively working to separate you from your money. Lower income customers face a different version of this problem. They receive fewer premium offers, but more predatory ones. Balance transfer promotions with hidden fees. Personal loans at steep interest rates. Credit limit increases specifically designed to enable overspending. The targeting is precise because the data is precise. There's something even more concerning that most people never consider. Income data persists. When you tell a credit card company your income, that information doesn't disappear after your application is approved. It sits in your file. It gets used for decisions you'll never know about. It gets shared with affiliates and partners in ways that privacy policies technically permit, but most customers would never expect. That income figure you entered 5 years ago might still be influencing how you're treated today. It might be factored into decisions about whether to increase your interest rate, decrease your credit limit, or close your account during economic uncertainty. Banks have long memories. Your data has a very long half-life. Now let me address the question you're probably asking. When do you actually have to disclose income, and when is it optional? Mortgage applications require income verification. This is federally mandated. Banks must confirm your ability to repay under qualified mortgage rules. You'll provide pay stubs, tax returns, and employment verification. There's no getting around this, and frankly, you wouldn't want to. Buying a house with no income verification is what caused the 2008 financial crisis. Auto loans typically require income disclosure, though verification standards vary. Some lenders do full verification. Others accept stated income. The necessity depends on the lender and loan amount. Credit card applications ask for income, but here's what most people don't know. Credit card companies generally do not verify the income you report. They can't access your tax returns without permission. They can't see your pay stubs. They're relying entirely on what you tell them. This creates an interesting dynamic. Banks want income data badly enough to ask for it, but not badly enough to verify it. What does that tell you about how they're using it? Those periodic income update requests that pop up in your account are entirely optional. You're under no obligation to provide updated information. The bank wants it, they don't need it. Those pop-ups are designed to look mandatory while being completely voluntary. Let me be absolutely clear about something. I am not suggesting you lie about your income. Providing false information on a credit application is fraud. It's illegal. It's genuinely wrong. Don't do it. What I am suggesting is that you think strategically about when and whether to volunteer information that will be used to make decisions about your financial life. There's a significant difference between lying and declining to update. When a bank asks you to update your income mid-relationship, you can simply close the pop-up. You can leave the field blank if possible. You can decline to provide information that isn't legally required. This isn't deception, it's privacy. Consider the asymmetry of the relationship. Banks hold enormous amounts of information about you. They know your spending patterns, your payment history, your debt levels, and your financial habits. They use sophisticated algorithms to analyze this data and extract maximum value from the relationship. Meanwhile, you know almost nothing about their internal decision-making processes. You don't see the algorithms. You don't understand the categorization. You don't know how your data influences the terms you receive. Refusing to volunteer additional information simply reduces the asymmetry slightly. It puts you on marginally more equal footing. The bank can still see your behavior. They still have substantial data about you. They just don't have the one specific number they want most. Here's a practical example of how this plays out. Imagine two customers with identical credit profiles, identical spending patterns, and identical payment histories. One customer regularly updates their income when prompted. Their income has increased from $70,000 to $95,000 over 3 years. The other customer has never updated their income since the original application. The first customer now receives aggressive marketing for premium products. Their credit limit has been increased twice without request. They're being groomed for higher fee products because the algorithm sees growing income and growing opportunity. The second customer receives standard marketing. Their credit limit remains stable. They fly under the radar because the bank's algorithm has less information to work with. Which customer is better served? It depends entirely on what you want. If you want maximum credit access and don't mind aggressive marketing, update everything. If you want to be left alone and maintain stable terms, consider keeping your information minimal. There's another dimension to this that deserves attention. Income data affects how banks treat you during financial stress. When the economy weakens, banks review their portfolios and make decisions about which customers to retain and which to shed. Credit limits get slashed, accounts get closed, interest rates get hiked. These decisions are algorithmic, and income data plays a role in every one of them. A customer who reported high income might see their credit limit maintained because the algorithm projects continued repayment capacity. Alternatively, that same high income might make them a target for aggressive rate increases because ability to pay pricing suggests they'll accept worse terms. A customer who reported lower income might see preemptive credit limit reductions as the bank tries to minimize exposure. The algorithm treats them as higher risk during uncertain times, regardless of their actual payment behavior. The only way to avoid being sorted by these algorithms is to give them less data to sort. The less the bank knows about your income, the more they have to rely on your actual behavior. Payment history, utilization rates, and account longevity become the primary factors because income data is absent or outdated. Behavioral data is harder to game than stated income. If you pay on time consistently, maintain low utilization, and keep accounts open for years, those signals speak louder than any number you might enter in a form. Your actions become your profile, rather than your claimed income. Let me share something that happened to a friend of mine. She was a contractor with variable income, sometimes earning $8,000 per month, and sometimes earning $15,000, depending on project load. When she applied for a credit card, she reported her income conservatively, using her lowest earning months as the baseline. 2 years later, she received a credit limit increase request. The bank asked her to update her income to process the increase. She entered her current earnings, which were substantially higher than her original application. Within 3 months, she started receiving constant calls about personal loan products. Her credit card offers shifted entirely to high annual fee premium cards. Her mailbox filled with balance transfer promotions designed to encourage debt accumulation. She had been reclassified. Her peaceful relationship with her bank became an aggressive sales campaign. She never updated her income again after that. When the pop-ups appeared, she closed them immediately. Her banking experience returned to normal within about 6 months, as the algorithm stopped receiving fresh data and her profile gradually decayed toward default treatment. This illustrates something important about bank data strategies. They're optimized for fresh information. Stale data is less valuable because it's less predictive. A 3-year-old income figure doesn't trigger the same algorithmic responses as a recently updated one. Banks know this. That's why they ask for updates so persistently. Every time you provide fresh data, you reset the clock. You become a newly classified target. The algorithms wake up and start working on you again. There are legitimate situations where updating your income makes sense. If you want a higher credit limit and your income has increased substantially, providing that information can help your case. If you're applying for a new loan and a higher stated income improves your approval odds, disclosure serves your interests. The key is intentionality. Update your income when it benefits you. Decline to update when it serves the bank more than it serves you. Make conscious decisions rather than reflexively filling out every form presented to you. Consider the lifetime value calculation banks perform on every customer. They estimate how much profit they'll extract from you over the entire relationship. Income is a major input to this calculation. Higher income suggests higher lifetime value, which justifies more aggressive acquisition and retention tactics. When you refuse to help banks calculate your lifetime value precisely, you become harder to optimize against. You introduce uncertainty into their models. Uncertainty generally leads to more conservative treatment, which often benefits the customer. There's also something to be said for the psychological dimension of this issue. Banks have trained us to feel obligated to provide information when asked. The request carries implicit authority. The form creates implied requirements. Most people comply because non-compliance feels awkward or risky. Breaking this conditioning is genuinely liberating. The first time you close an income update pop-up without providing information, you might feel slightly anxious. Did you do something wrong? Will there be consequences? There won't be. The bank will ask again in 3 months. You'll close that pop-up too. Nothing will happen. Your accounts will function normally, your credit score won't change. The bank simply won't have the fresh data they wanted. Over time, you'll realize how much of banking is theater designed to create compliance. The authoritative forms, the urgent requests, the implications of requirement. It's all constructed to maximize data collection from customers who don't realize they have choices. You have choices. You always had choices. The bank just preferred you didn't know that. Let me give you specific tactical recommendations for managing income disclosure going forward. For new credit card applications, provide income information because it's essentially required for approval. But be thoughtful about what you report. If you have variable income, you don't need to report your best month. If your income has multiple components, you don't need to include all of them. Report accurately within these parameters, but don't volunteer more than necessary. For income update requests on existing accounts, close them without responding unless you specifically want something that requires income verification. There is no penalty for ignoring these requests. They will disappear and eventually return. You can ignore them indefinitely. For credit limit increase requests, decide whether you actually want the increase. If you do, providing updated income might be necessary. If you're happy with your current limit, decline the request rather than providing income data to enable an increase you don't need. For loan applications where income verification is required, provide what's required and nothing more. If they ask for tax returns, provide tax returns. If they ask for additional documentation beyond what's legally required, ask why before complying. When banks call asking to update your information, remember that phone calls are designed to create pressure and immediacy. You can simply decline. You can say you're not interested in providing that information. The call will end, your accounts will remain open. The broader principle here extends beyond banking. Every institution that asks for your data is collecting it for their benefit, not yours. They may frame requests as serving you better, improving your experience, or ensuring accuracy. These framings obscure the actual purpose, which is enabling more precise extraction of value from your relationship. Data minimization is a legitimate strategy for navigating institutional relationships of all kinds. Provide what's required. Decline what's optional. Understand that every piece of information you share will be used, analyzed, and monetized in ways you cannot see and would not approve if asked. Banks are not evil institutions. They provide valuable services. Credit cards, loans, and deposit accounts enable economic participation in ways that benefit everyone. But banks are also profit-maximizing entities that treat customer data as a resource to be exploited. Understanding this dynamic doesn't require cynicism, it requires clear-eyed awareness of how the relationship actually functions. Banks want your data because it helps them make money from you. You can choose how much data to provide based on what serves your interests rather than theirs. The next time that income update pop-up appears, you'll know exactly what's happening. The bank wants fresh ammunition for algorithms that will optimize their profit, not your experience. Close the pop-up. Keep your information to yourself. Let your payment history and responsible behavior speak for themselves. That's the data that actually matters. And unlike stated income, they can't get it just by asking nicely.